Let's get started. So I have four classes today. My last 4 classes I'm teaching. I had 5 before that, but the last 4 I'm doing in my circuit of classes is just things that I came up with. I've been now doing this for a couple years. I started training a couple years ago with Heavy Bid, and my background is that I came up, out of school, and then I did the project engineer thing, the PM thing, the regional manager thing. I had a company, did the CEO thing, owner stuff. So I've kind of been, all the way through. And when I exited my company a couple years ago, I called here and said, hey, I'd like to maybe do some training for you. And Chris Henry, who's third in command or wherever he is, he said, if you ever talk to Chris, I won't use the colorful language he used, but it was to the effect of get on a plane immediately and come down here with some 4-letter words and some New York accent. All that being said, I came down, like I said, about a year and a half or 2 years ago, an interview, and I've been going out doing all these trainings. And it's been great for me because I get a national footprint, if you will, across the country. I've seen everyone from Boston to Oahu and Honolulu, where I live, and I just get to see a lot of stuff, so I really enjoy it. But one of the things that I brought up this year was I was assigned my normal 4 courses or whatever, and whatever they were, the technical things at Heavy Bid, and I suggested to Melody, the woman, and Tom Webb, the COO, I think Tom's title is, I said, why don't you teach some business courses, something which teaches these owners, CEOs, whatever, just things about business and construction. So this year we're trying something a little bit different, where if you came here to see Heavy Bid, I don't have it on the agenda to show Heavy Bid at all, so we'll just see how long this goes, and if we have comments, give them, but this class is supposed to just be more or less business and financials and how to be an owner of a company or be an executive of a company. So those are the things that I've seen on the road that a lot of people don't understand when I sit there with owners, or they take me out to dinner and we talk, and we kind of share war stories, so to speak. The owners really like to talk with me about things because I have been around, at least in the country, seeing all these contractors. So I've gained a lot of experience through HCSS. It's been great. I am a PE. I'm not a CPA, so that's my little disclaimer that everything that I've learned, although I started in the College of Business and I graduated with an engineering degree, I've picked up some things in accounting along the way, being a business owner, and I just thought these higher level things, which your CPA probably won't agree with some of the terminology I use, but as construction people, are there any accountants or CPAs or CFOs in the room? Oh boy, all right, well none of you can ask questions or challenge me. But there will be some terminology here that probably you 3, I think there were, that I'll get wrong, so to speak, but this is how engineers look at money and how me as a company owner did. So I'm just going to take you through some of the things. I've got some data up on the board that we'll throw around, and we'll see how it ends up. So the course is called Eyes Wide Open, Financials and Fraud. I just kind of threw that at HCSS, and they just put it up there. The next one I'm teaching is called The Unsexy Indirects or something like that, and I made that up, and they use that as well. But so I just want to go through and look at financials and start to talk about them. And so you as executives or owners, I assume the financial people are probably better versed than I am in how to read what I'm going to put on the board. But at the end of the day, just real good stuff as an executive in a company, or especially an owner in a company. Next one, please, Justin. Okay, so the objectives for this course, as I laid them out, primarily talking to owners, executives, or financial professionals in the company. Or if you're in the back of the mind and thinking about having your own company, this is another good course for you to take if you're thinking about doing your own thing. I did, and a lot of these things I learned along the way. So next click. So the basics of reading construction financials for your own use: be smarter than him or her. So I want you to be able to read a financial statement and then be able to figure out some things in there about either your subs or your suppliers, because if you end up working for a general contractor, some of these multi-billion-dollar companies, where you've got to qualify ahead of time, you've got to submit financials to them, and they're looking down on your financials at things, and you better know how to read these financials, not only so you know what you're giving your surety or up to the general contractor, or what you're reading down below from your subcontractor or your suppliers. It's good to know at least the basics of how to read a financial report. What your users are looking for in your financials, and what you should see in your subs, like I just stated. So every user of your financials needs something different out of it. Some guys want to see how much cash you have. Some people want to see a debt-to-equity ratio. Just different things along the line that different users want to see, and from there they decide whether or not they're going to extend you credit. Or give you the job. It really depends. But that's what those guys are looking for, and you should, like anything when you're providing information, you should know the answer before the question gets asked, so you should be knowing what they're going to ask and provide the right information to them. so that you know you're going to win the job or whatever the case may be, get the loan, whatever it may be. Next. The third thing I want to touch on, and I will tell you that a lot of the stuff you're going to see in here, the concepts and some of the examples that I gave in my last class, this class and the next class, is from my experience, either my direct experience or someone who's told me, at least whatever that is, firsthand, secondhand, as far as experiences they've had. So a lot of these things I've seen. And so I wanted to talk to you guys real quick about keeping an eye out for fraud and embezzlement. And probably the three financial professionals in the room probably will have seen more examples than I have in my career, but I'd be curious to hear if you guys could share at least what you've seen when I get to that, as far as things that maybe you've seen that maybe I haven't mentioned. Or, yeah, Scott, we did have something like that happen, or it happened to my friend or whatever, but it happened to me. And don't think it's not happening to you. Next. The three financial reports. Okay. Click. So the first one is the income statement, also known as the P&L. Very simple statement in that you take however much money you made in a period of time, and then you take away the amount of money you spent in that period of time, and whatever's left over is called profit. That's the first major, in my opinion, the first major financial statement. There's three of them. The second one is the balance sheet, which is assets and liabilities. So all the things that you own minus all the things that you owe money on, that difference is called equity. That's called owner's equity or stockholder's equity, whatever it may be. And then last one, the cash flow statement. All right, there's three accounts in here. Do you guys know how to read those? She says yes. So even my CPA is like, meh. So that's why I put it in there. To me, they're hard to read. They do mean something. I have actually gone through them. What is the main purpose of it? Do you use it?
Yeah, our cash flow statements are important because they let you know when you're having cash come in and come out, and when cash is king. It's really important. So.
Yeah.
Important.
Yeah. I wouldn't disagree that cash is king, but as far as being able to read it, I was never able to really understand it truly and never use it. So, I always did it on a job-by-job basis where at least I knew that, I was on a $30 million job, and I convinced the owner to give me $2 million this month when I know I only spent $1 million. So I knew at a local level, always the project manager, how my cash flow was going. But as far as you on a global scale, where with your company's 10 million or 100 million or whatever, I'm sure that would be a big deal to you if you know how to read it, which I don't. So next. Okay, so the income statement, the basics. Keep it simple, stupid. That's KISS. So that's all I'm trying to do here is just boil it down to the basics. I dropped accounting freshman year of college because I just sucked at it and didn't like it very much. You become a business owner and executive, you got to learn how to read financials a little bit. And I'll tell you that some of the information I got in here, you can go down, and I asked if I could use some real data for some real companies. I kind of got poo-pooed because they were could have been potential HCSS clients. So I understand that, but it's I used to have a client, Lennar. I don't know if anyone does any work for Lennar. I'm not going to ask you to raise your hands, but Lennar is publicly traded. You can go on Yahoo Finance and you can pull up their financials. I always like going in there and say, why can't you pay me this $1 million? Because I just looked in your bank account and it had $908 million. So that's always good. It's always nice when I printed it out too, just kind of being a punk, but it's all public information. And some of the clients that we have, of course, I was going to use one, and of course I got stomped on. But you can look that stuff up, and everything that I'm going to show you in here, you can go and you can look how different businesses run. I think it's pretty interesting, if you like things like this. So as far as in a period of time, so the income statement is based on a period of time. This is the first thing you learn in accounting school, which is an income statement is based on a period of time from, say, the first month or the first quarter or last year, whatever it may be. We're going to have revenue minus cost equals, this is where the accountants probably will start to get after me. I'm going to say it's called gross profit. And after you take away from the gross profit you made at the job level, we're going to suck out the general and admin costs, and that's going to be left with net profit. I didn't go further below the line than other income and other things like that, but this is basically how it's laid out. And if you go out to Yahoo Finance and look at any of those financials, you're going to see something like that if you just break it down. Next, Justin. So simply speaking, you're a $10 million company. Last year you did $10 million, or your sub did $10 million, and you're looking at his financials. He had a cost, which is also known as COGS, which is cost of goods sold, and that was $9 million. So he made a gross profit, or you made a gross profit of $1 million. Then we had to come back into the office, and in the corporate office, we had to keep the lights on, we had to pay the lease, we had to pay everyone in the office their salary and whatever else may be there. But The G&A is what is being spent back at the home office. And after you suck out that, you're left with $400,000. So this company made $400,000 on $10 million. Certainly not unheard of to make that sort of return. Accountants. I can't get someone to tell me if this is the line. That's why I said opinions vary. This is what I call the line, but I called 2 other accountants, and they both give me varying answers. But this is what I've always called the line. When you hear people walking around and saying, oh, well, those costs will fall below the line. Well, what did that mean? If you look in your financials, if you're a business owner, there are certain costs that will go up into the actual job site operations of your company, which is this line here. Everything that happens above my hand is really happening out on the job. You got a $10 million job, you laid the pipe too slow, you had rain and lost money, you did a really good job on pickup and you made more money, but everything above what I'm calling the line here are things that you're doing on the job. Some costs go above the line and below the line. Again, the accountants will have a better idea of things, but the things I always see are insurances. Sometimes the insurance gets job costed, sometimes it sits in corporate overhead and it falls below this line here. And it really, it takes away, it increases the cost of the corporate overhead or not, depending on where certain people are coded. At the project management level, where this always comes into play is, why is that guy in the office charging labor to my job? He should be below the line. So you got you guys who might be estimators in the room, and whatever it is, you're making $100,000 a year, and all of a sudden $50,000 a year salary is showing up on Highway 610 job. Well, I'm the project manager on that job. I haven't seen Bill out there the whole time. Why is he getting hit to my job? Because there's some accountant back in the office putting this money up above the line and affecting your job costs. It's just how business works. At the end of the day, it doesn't change the number on the bottom, but of course, when those costs get moved up there, they end up having gives your job a different result. Obviously, it decreases the profit. So, but I've been into a lot of times when I go into clients and we talk about overhead, we talk about where costs fall, above or below the line. And I'll have clients in here like, oh man, we did 10 million and we only spent 7 million. We're making 3 million a year. Wow, that is awesome. Wow, gross profit of 3 million. What do you spend at G&A? Well, we spend like 2.9. Oh, so you make $100,000 a year on 10 million. Yeah, but we got great crews. That normally doesn't have anything to do. This guy had a lot of nice trucks and brand new office, and he just repainted his office, and he had like $3 million of work or something. But all that being said, it does make a difference where you put these costs, and sureties will pay attention to it too. If you can't make money on your jobs and you're losing here, the surety is not going to be too excited to extend you more credit if you can't make money on your projects. Next. Okay, so here's just, I pulled some data out, I threw it on a sheet. So here's a contractor that was in business for these 4 years, year 0 to year 1, year 2, year 3. So this is just all the years stacked up next to each other. So you have all the revenue there. This contractor did 14 million, 22, 12, and 22 up here. And this is generally speaking at a high level. If you haven't seen a CPA generated report, this is pretty much what it looks like. It has a few other bells and whistles, especially down here with other income you got from different accounts, bond accounts, or some other cash transactions you had down here, which the accountants in the room will know better than I. But this is a pretty real example of a set of financials. So let's go to the next sheet. And what can we see? So when someone puts this in front of me, and this is going to be, I'm a general contractor, I look down, I'm considering hiring the subcontractor. What am I seeing in these financials that this guy's giving me? Or what is my surety seeing, or whatever? So let's look at some of the numbers you see on here on this income statement. So give it a click, Justin. So just some things, and if you have read income statements before and you want to comment on what you see here for anything that I missed, feel free to do it. But when you're looking at financials like this, some of the things you should be looking at. As a business owner, I'm looking at this and I'm saying, okay, well, revenue and profit in years 1 to 2. Let me grab my laser pointer. Ooh, I'm tripping on that thing all day. So in years 1 and 2 here, we had revenue go down and profit went up from 1 to 2. So a lot of people talk about that, getting big early, too early and growing too quickly and not being able to keep up with it and losing money. Well, here this contractor did 22 million and then 12, and as he decreased the actual revenue he was doing, he was making more money, at least at the top level. See, at the bottom, it really didn't make a difference. In years 2 to 3, he was doing more revenue, 12 to 22, but then he was losing money. So you hear that all the time, you know. You start doing more money, it just becomes more commodity type work, and you just can't make as much money. And you're having to feed more revenue into the system in order to pay for the corporate office or what have you, but those are the things that I see there that I pointed out from this contractor's financials. Years 0 to 3, the G&A dollars are growing steady, but revenue is not supporting the G&A in year 2. So that's what we were just talking about, which was we made good money here. We made good money, we made 11% gross profit on this, which is all good, right? And it looks like, you know, at a high level, right? Well, we didn't change on the overhead. We were still manned up, womaned up, back in the office to support $22 million. It looks like we had just about the exact same expense back in corporate. But because of that, we didn't take advantage of it. So we had the same return at the end of the year where my revenue was decreasing and I couldn't get rid of all this G&A here, and then at the end of the day, you know, this contractor wasn't able to capitalize on it. Ended up not benefiting at all. You know, wasn't able to keep the revenue up. I don't know what years these are, but so year 0, tough year end or aggressive writing off. I was with a company about 12 years or so ago, and they bought us, and they changed everything about the way we cost reported. And we were a contracting firm. We got bought by an engineering firm, and they wrote a lot of stuff off. They came in, and the cost controls were really hard to manage, and it just became a big mess. But we just had huge write-offs. And I will tell you, if these are coming at you on a job-by-job basis, and if these are controllers or CFOs in the room right now, they're going to tell you that, you know, it's okay to hide acorns, as I used to always call it. You know, you're always trying to hold out and hope that the profit holds, and at the end you just slam in a whole bunch of profit. But if you do this in reverse and all of a sudden you slam in a whole bunch of loss, that makes sureties really nervous. So if you're trying to build up a bond program and all of a sudden you come at the end of every job and, oh, we were going to break even, now we're going to lose 6%. We were going to make 14%, but now we're making 3%. So those don't fly very well with sureties, and there's no set equation on how you increase your bonding capacity or maintain it, but things like that all get stuck in the back of your surety's head, and the next time you need that bond, well, you don't know how to protect your jobs, and I'm not taking that risk with you. And so you'll see that happen. But this seems to be I don't know what happened here with this guy, but they obviously had something happen, so looks like they didn't break even, but anyway. Next. So the second major financial report is the balance sheet. So here we go again with the basics. And this one, last time, the income statement was a period of time. This is a point in time. So at a point in time, the 1st of here, the 31st of there, whatever it may be, you're going to have a certain amount of assets. This is cash. This is investments, accounts receivable, equipment you own. You're going to have liabilities on the balance sheet. It's going to be accounts payable, debt, whether it's short-term or long-term, and you're going to have equity, which is just basically mathematics, the difference between the two. Assets minus liabilities. So here's another company. Here's our example company again. She's got $14 million in assets, and she's got $12.5 million of liabilities, and 14 minus 12.5 is 1.5. So 1.5 million, this is your worth as an owner, right? You could sell that company today and make $1 million. Advance? No way in hell. That number does not mean that. And I had to learn that from my controller, where I was building up my company and the numbers started getting pretty big. I was like, wow, I'm really doing well here. He's like, that number doesn't mean anything. And if you ever talk with an accountant, at least my accountants, whether you were killing it or whether you're losing your butt, the expression was always the same. Yeah, we did really well this year, we made $3 million. Or we did really bad this year, we lost $3 million. It's always the same. So here it was like, no, that number doesn't mean anything. And it doesn't. So this is, if you ever go to sell your company, it's based on EBITDA, which is an earnings calculation, and several other factors in here, and some of it's goodwill, and a lot of it's management and other things like that. But this number really doesn't mean this, because this number is assuming a lot of things mainly was a lot of things. It's assuming all your equipment can be sold for the price you think it's worth. Man, that loader is like 14 years old. You really think it's worth $40,000? And you got 12 of them? I mean, come on, really? It's going to be Ritchie Brothers for $7,000 a pop. But if you have that listed under your equipment, that's what this is showing, then this is how you're lying to yourself. Any comments, any accountants on that one? Am I right? No, this one over here is like, no, you're not exactly right.
No, I mean, you could sell a company for whatever you want to sell it for.
Yeah, that's true. That's true. Okay, so next slide. So this is the balance sheet. Our contractor here. Let's see, what do I got? So it looks like in year 0, we've got, here's the total assets right here. So we have total assets here. Total liabilities down here. The difference between assets and liabilities, just 2 minus 1 equals 1 or what have you. In the asset list, we have current assets. And the liabilities, we have current liabilities, not current liabilities. So we're going to go through this in a little bit of detail, and we'll look at this. So what do we see here? So here are some current assets. So let's. This is the current assets portion of the balance sheet. We're not looking at liabilities. We're not looking at equity. I parsed that out of the financials and just splashed them up there. So let's see what we see here. So the blue line, current versus non-current. Current means you can convert to cash in less than a year. So these are current assets. You can see there's cash, marketable securities, which is, say, a bond account, things like that. Contract receivables and retention money, which hopefully will be coming in the next year. Prepaid expenses down towards the bottom here, $166,000 there. Non-current assets here, $1.1 million, it looks like, in property and equipment. Things that wouldn't be able to maybe turn over in a year. Those are all there. Next. The assets are ordered in how fast they can become liquid. In the event that the surety comes in and says, I'm taking over and I'm going to make you penniless and homeless on the street, they can go through here and they can see in what order things will come out of your pocket and how soon they can come out of your pocket. So in the case of cash, that's obviously the best, right? And this guy here, he had marketable securities, which were bond accounts. And so if you have a company, you're thinking about putting money somewhere other than whatever money market returns now at 0.03%, maybe it's better now, but obviously for a long time, we weren't getting any money at the banks. Marketable securities and something like a bond fund, if you decide to put money somewhere other than a bank, I would talk to your surety because you should be able to see whether or not this cash here can count one for one. You know, so this is $527,000. Is that really valid for all $527,000 of potential bonding capacity in my calculation? Or are you discounting that because I'm in a bond account and it's going to take 3 days to liquidate versus right at the counter with my actual teller? So these always go from most liquid to least liquid. Next, please. Marketable securities I just talked about. So marketable securities up here, stocks, bonds, things like that. Prepaid expenses. I always see this as insurance. Can be deducted in a bond calculation, though there I have. So prepaid expenses, I made a comment in another class today where insurance was usually paid today for the next year to come. So today you get your insurance bill for the year 2018, you pay it tomorrow, it was $100,000. That payment becomes an asset, right? Because you paid for $100,000 for the next 364 days of coverage. So that becomes an asset called a prepaid expense. But you'll see when we get into some working capital calculations here in a few minutes that this doesn't really get counted as a full amount of money towards your bond program if that's the reason the number is being looked at. Prepaid expenses aren't counted dollar for dollar. What do you got next, Justin? Okay, so current liabilities. We just went through the asset side of the house, so now let's go over on the other side of the balance sheet and look at liabilities. So what do we see here? So current liabilities, same as current assets, except that these are due and owing in less than a year. So those are things like lines of credit, accounts payable, all those things that you're going to have to pay in the next year. Things that probably aren't due in the next year are the portions of your debt that you have to pay back to Caterpillar or whomever, or on your building that you own, or the land that you own, things like that. But everything up here in the current section is going to be due 1 year or less from today. Accounts payable. This is a really easy one, but one that when I go and I talk to contractors, I'll have contractors, say, "Oh yeah, I looked at his financials. He's got a ton of cash." That's great. Does he have a ton of AP? Because then the cash is useless. It's all due to someone else. So a lot of times I'll look at that and I'll talk to people and say, "Oh, he's healthy. I know he's got a lot of cash in the bank," or I'll have people, when I had my construction company, "Oh, how much cash you got in the bank?" Does it really matter? If I got $1 million and I owe $2 million, I'm $1 million short. So I would say anytime you look at someone or someone's talking about how much cash they have in the bank or cash is a measure of the health of their business, I would say that it really doesn't mean anything until you come over here to current liabilities, which should be obvious, but just keep it in mind. Yellow, the current portion of long-term debt. This is important for the working capital calculation. When we get to it in a couple of slides, we're going to go through a sample of how to calculate a bonding capacity for this $10 million company, whatever they are. But the current portion of long-term debt is very important in calculating the working capital. We'll get to it here in a minute, but note that if your CPA doesn't have that line on your financials, then you need to be asking. Or even better, once I actually learned what that meant as I came up in business, I would start to ask, and my CPA would kind of scratch his head thinking, "Oh man, this guy kind of knows what he's doing now a little bit." So that's one I've seen it missed before, and you'll see how important it is when we get to it here in a couple slides. Billings in excess of cost. This is an indicator of cash flow. So one thing that I had a tough time learning as a business owner was I had always been taught to take advantage of cash flow and bill as aggressively as possible. I had one job where it was a $100 million plus job, and one time we were $28 million ahead in positive cash flow. I felt like a stud. It was great. I had nothing to do with the financials there. It was earlier in my career, but I learned once I became a business owner that this becomes a liability. And it's still all good. I mean, there's no reason not to bill as aggressively as possible, but at the end of the day, it does fall into the liability section of the balance sheet. And if you're thinking about becoming an owner, or you're going to be starting to look at financials, you're going to see that falls there, and it just doesn't look right, but that's where it falls. Next. So who are the users? The users of our financials are banks, because they're going to extend you credit on your equipment line or on your operating line of credit. The sureties, because they're either going to extend your credit card for building jobs. I mean, a surety program is nothing more than a credit card you can use. You're not borrowing their money, but they're extending you credit on how much work you can bid publicly. General contractors, if you're bidding up to a general contractor, they're going to be looking down and qualifying you to do certain jobs from 0 to 1 million, 1 to 5, 5 to 25, whatever it may be. Suppliers may be looking at your financials to see whether or not they should extend you credit. That's quite popular as well. And we were licensed in Idaho at one time, and you get and I think probably several states, you get graded on how much work you can actually bid based on your financial strength. So licensing boards, contractors' licensing boards, they also look at your financials. Next, please, Justin. Okay, so what are they looking at? So they're looking at these three things, if not more. Next, please. Okay, so covenants is a key word that I use, and you'll start to have to meet these as you go through managing a business. So here we have working capital. I abbreviated current assets with CA, and I abbreviated current liabilities with CL. This is to me because, as this woman said here, and I said a class or two ago, working capital, which is basically a measure of cash, is the most important thing. Cash is oxygen. So you have no working capital, you are in trouble. So this basically is a measure of cash. Current ratio is the same sort of thing. It's just a ratio of current assets over current liabilities. And then net worth is just equity. How much money is this guy worth? So Scott Jennings owns a construction company. How much is he worth? And he's worth $1.5 million, whatever it is. So whatever the company is worth, they could theoretically liquidate you for if they had to. So surety, back over here on the purple circle. Sureties vary on how they grade you and how they offer you surety credit. We're going to what, 3 o'clock, yeah? Is it
Yes,
3?
3 o'clock, that is correct.
Okay. So sureties will grade you upon usually one of two ways. Your net worth, so you're worth $1 million or $100 million, whatever it is, or a lot of times they do it by working capital. it's not strictly by cash. If you've ever worked in the surety world or you've had your company and you've heard that expression, the 3 C's of surety, is what character and capital or cash, and then controls, these 3 C's. They are important. When I had my business, I didn't think character really went very far, but character goes a tremendous distance with the sureties. They can look you in the face and not know you're going to run off with money or sell your gear or be gone, because it happens. You hear stories. But so character is important. And this one, cash, is very important. A lot of times you'll get bonding based on how much cash you have in the bank, or not how much cash you have in the bank, how much working capital you have. So if you have, $2 million in cash and you have $1 million in accounts payable, you've got a working capital of $1 million. So we're all rough numbers, but that basically is how it works. And bonding can be anywhere from 10 times, 15 times, 20 times, 5 times, it depends. And this number, at least in my career, you guys may have something different if you deal with your surety, but the bonding is never just a hard number of, we'll give you 10.3 times working capital. It's always kind of, we'll give you a $10 million program. How about a $25 million program? And that always varies. But I'm sure in the background, this is where a lot of it is based, is on working capital. The bank used to grade us on a covenant of the ratio between current assets and current liabilities. And if it wasn't greater than 1.15, they reserved the right to just cut you off. So if you had an operating line of credit and you weren't maintaining that covenant, they reserved the right to cut you off at the knees whenever the heck they felt like it. Same with the net worth. Covenants vary with smaller contractors, 1 to 25 million or whatever. The bank may say, all right, well, we're going to put a covenant on you of you must at least maintain a net worth of $1 million or more. These are all things that you get graded upon as people extend you credit and evaluate your financial strength. And then, like I said before, surety also looks at your net worth here on the bottom to grade your bonding capacity or award you more capacity. Next, please, Justin. One more. Okay, so on this one, let's look at a little working capital calculation. So you could go back and you can look at this PowerPoint if you want. Hopefully my math is right. But here we took just the current assets minus the current liabilities and got these numbers on this line. So in year 0, it looks like the company was starting. It looks like they were building up. And if you look at a working capital times, say, 15, I kind of split the babyish a little bit and went to 15 times working capital. This particular contractor looks like, just in rough numbers, they started out with a $4.4 million program. They kept growing. Looks like they took a hit here, or they were using cash for other reasons. But at the end of the day, on a working capital calculation, the surety was able to probably give them a program of whatever, 4 to 14 million, depending on the year. So that working capital got cash. Next, current ratio. In this case here, looking at the covenants on the last page, if we look at the current ratio here, 1.15 is what the bank required. Looks like only in year 2 did the contractor actually meet it. His assets were never large enough over his liabilities to pass his covenant. And then net worth, looks like the first year he didn't make it, but it looks like the next 3 years he was building his net worth, and the covenant of $1 million he seemed to be okay at, for those next 3 years. So you can do the math. 1.1 million is greater than $1 million. So I put this in here. It's I've heard it once or twice, but not a lot. But if the bonding capacity does get measured off of actual net worth, and that would be that. And the net worth, obviously, like I told you before, got enough equity so the user can liquidate you if he needs to, or she. Next. Tips. So prepaid expenses, say insurance, may or not contribute to your working capital. So I told you that working capital was current assets minus current liabilities. If you remember, in the bottom of that current assets section was prepaid expenses. I don't know what it was. It was $100,000, whatever it was. So that contractor paid today that $100,000. Well, that $100,000 isn't so much liquidable. You can't liquidate it very easily. So they take a discount on that. Say, well, we saw you had $100,000 there in current assets, but we only gave you 50% in that working capital calculation. That's a popular way your cash gets discounted along the way as they travel down your financials. I told you this before on the blue one, don't stop at cash, look at AP. That's happened to me 3 or 4 times where people say, oh, he's got so much cash. And then I flip the page and it's like, yeah, but he's got a lot of AP too. Current portion of long-term debt. Big difference in working capital and resultant bonding capacity. So I showed you on the last slide how working capital works to gain you bonding capacity. you'll see here if you don't take care of your current portion of long-term debt, I think the next page I'm going to show an example, then you'll see how, that's all good. That's good. So I'm going to show you on the next page right here, Justin just went to, where the current portion of long-term debt, how that's calculated. So let's go through an example of, say, a $100,000 excavator purchase. So I bought a $100,000 excavator, and I basically got to pay $25,000 a year for 4 years. Obviously, I don't have any interest in here, just to keep it all simple. So give it a little click there, Justin. So recall that working capital is current assets minus current liabilities. So a good CPA will go through here, and he or she will say, all right, well, $25,000 is current, so $75,000 is the long-term portion, right? Because I told you that current liabilities, current assets were going to be received within a year, and current liabilities were going to be paid out within a year. So in this case, we want to make sure that we get the right amount in current, because our current liabilities is the calculation we use in working capital. So if you give it another click, your future ex-CPA, he or she's going to say that you have $100,000 of current. And this has happened to me, where if he or she is not taking the time to just look at the portion which is due in the next year, and he or she puts the other $75,000 in here, you just lost, click. So the difference between this $75,000 error, if you're error on a smaller contractor basis, is, I mean, that's a lot of bonding capacity for a smaller guy. And if you're someone else who does 10 times as much work, I mean, just keep adding zeros. So a mistake like that made across a fleet of a class or two ago, the instructor was saying they had $100 million a gear. You know, I don't know, a $75 million mistake there, that might affect the bonding capacity. So. Okay, next please, Justin. So this is the last section that I want to talk about, and it's about fraud and embezzlement. And let's see what comes up here and see what sort of anecdotes I might be able to throw at you. So things you're telling yourself right now. Now, that couldn't happen here. I worked with these guys for years at that other company. It's all good. Said that a lot. We're really lucky, man. We have really great people. They've been with me forever. Yeah. I've heard all those things, and I said them myself. Just quoting myself up there. I should have said by Scott Jennings. So these are the things where some of these I just kind of, my sister is a CPA, so she shared some of this with me, and some of it I've seen myself, but some of it I just picked up. I don't have so many anecdotes here for all of them, but go ahead and click. Some of the office embezzlement techniques that I've either read about or experienced is a fake invoice. You can have fake invoices in accounts payable, where the accounts payable clerk creates a fake invoice to a fictitious company. That one didn't happen to me, but it's happened to a friend of mine, so that stuff happens. The vanishing invoice. So in accounts receivable, payments may be diverted to a phony account and invoices are removed from the system. And payroll, I don't know that this one's so much embezzlement because a lot of times it's made by mistake, sometimes not, but payroll, paying the wrong pay rate, paying too many hours to a certain person, or paying for a non-existent employee where someone's just made up and somehow that's finding its way into an account. Some of these things sound like BS, but they happen. Online accounts. I don't know how my admin assistant ended up in San Diego and I lost $300 out of my Hawaiian Airlines account, but somehow that happened. So things like using the Office Depot account, the Amazon account, using the Hawaiian Airlines account to fly you and your boyfriend over to Kauai. Just making stuff up, right? This didn't happen to me. Credit card points, so people can abuse those as well. It's not heavy embezzlement, like you would see or read about, but it's all stealing, Next. So field embezzlement techniques, this is my specialty. Salvage. Job site assets like gravel, dirt, house furnishings, timbers, precious metals, or just common steel. We had I had a job once where we were making gravel in the winter. It was in a wet climate. We were making gravel, and you're pulling gravel out of the ground in the middle of the winter. Everyone wants some. You can't move dirt in the winter because it's raining. But we had a whole bunch of gravel, and I was lucky enough to have befriended a competitor's corporate counsel. And so one day I get a call from her on a Saturday saying, I just want to make sure, I got these W-9s from your two employees, Joe and Bill, and getting ready to cut them a check each for 22 grand. Just wanted to double check that that's what you want me to do. I said, well, what for? Well, you guys sold us $44,000 worth of rock, and I'm getting ready to cut a check. And those guys weren't with me any longer, but I just told her to, make the check over to our company, and I handled it from there. But it makes you wonder, how many other times has this happened? It happens all the time. Things like this, whether it's $1 or in this case, $44,000. And I'd known those guys for a long time. They came from a good company. I'd known them for 15, 20 years. That's not what they said they were doing, but I don't know why else you would really do that. So use of company assets, side jobs with company equipment or materials, renting company property to others. You send some guy out on a remote job and you guys are paying the lease on a 1-acre lot to house some trailers or house some gear. That guy out there is actually renting a corner of the yard over here to, Joe and Millie down in the corner for $100 and renting out this part of the yard over here and just renting out company assets. Or I was always asked if, I think I was always asked that, hey, I want to borrow the backhoe. Can I go take it down the road over the weekend? I just said, return it with gas in it, please. If you just fuel it, that'd be great. Next. Fuel, I just mentioned that, so I can't tell you, I really can't tell you probably how many watercraft I've fueled, which aren't company watercraft. We had an issue where we had a guy who was going up to the pump and putting in the company card, and all his buddies were just lining up and just feeding them all, $100 of fuel on our company credit card and just collect $50. So everyone's getting, fuel for 50 cents on the dollar on the dollar out of my bank account. Expense reimbursement, personal purchases on the company credit card or bogus receipts. That one's pretty obvious. Next. Some ways you can prevent embezzlement. You can separate the duties. You can split the duties to multiple people. So whomever is signing or cuts the check should not balance the bank account. The person entering the invoices into the system doesn't issue the payments. So separate these duties. The person opening the mail doesn't make the bank deposits. Password protection in the case of HawaiianAirlines.com. Keep passwords protected to non-fiduciary websites like office supplies, general merchandise, airlines. More prevention. Asset reconciliation, fuel bills. I think everyone should be scrubbing their fuel bills. If you're not, I think you should. I know I was taken advantage of more than once, and I think it's a company thing. It happens all the time. It doesn't make it right, certainly, but if you're not checking fuel bills, I would say go do that for sure. A lot of money, and everyone can use it. Hard assets. Generate a system of regular asset check-ins where employees are required to report the whereabouts of equipment. Bank accounts. Account for cash use on a monthly basis. Petty cash. If small amounts of cash are kept on hand, make sure to have simple accounting in an envelope or cash box. We always had petty cash accounts, never kept more than $5,000 in them. So, and then trust but verify. I think that's from Ronald Reagan, isn't it, or during the Cold War or something. But anyway, it's hard to do and it's hard to believe, and if it happens to you, it's a punch in the gut. And if you don't think it's happening to you, you're just lying to yourself. That might be it. 2 minutes to go. I have nothing further to say. Anyone have any comments or questions or things to throw out about what you may do to combat embezzlement?
Kind of a depressing class.
Sorry. It's just the reality of it. So it's tough to be a business owner, as everyone knows. So, but you can have beer in an hour and a half. 2 hours, whatever it is. So. Well, I appreciate everyone coming by. Please fill in the survey because this was a different type of course and we didn't touch heavy bid. And if you guys liked it, great. If you didn't, let us know too because we'll run it next year. We won't. So appreciate your time. Thank you, everyone. Yep.